Welcome to Markets Now. I'm Michelle Rook along with Ted Seifried with Zaner Ag Hedge, and we had a lower day in the grains, higher in the livestock futures. And Ted, let's start off talking about the grains. We came off of a really good week last week, started off this week with pressure. We were taking risk premium or weather premium out?
Yeah, Michelle, we had quite a bit of strength, especially in corn on Friday, because we were concerned of what the weather forecast might look like when we got back from a 3-day holiday weekend. Well, when we got back from a 3-day holiday weekend, not much changed in the short run, but that 8 to 14-day forecast had brought in some cooler temperatures, below normal temperatures for a good portion of the growing area, and normal to above normal precip for a good portion of the growing areas. There's some exceptions with Wisconsin, Minnesota, and I'd say a little bit over half of Iowa that are looking for below normal. So not a completely clean or better forecast, but those cooler temperatures could go a long way to easing on any sort of stress that we're going to see in the beginning of June. So that was allowing us to take some of the weather premium back out of the market. And on top of that, we had quite a bit of risk off trade happening on Tuesday as well.
True.
So just all coming together, like you said, gave us a really rather heavy day.
So pinpoint the risk off where that was coming from, because we got a lot of China economic news out, and that seemed to be a bit negative, but was there more to it than that?
It's just a whole lot of different things coming from a lot of places. Obviously, here domestically, we're talking about the debt ceiling, which on Friday, it seemed like we were very close to a negotiated settlement on that. It seemed like that was going to go through. But then over the weekend, you had a lot of the GOP saying, yeah, we don't like this. We're not going to vote for this. So now it's a whole lot more uncertainty again. So that had something to do with it. You also have more cases of COVID popping up, a new variant of COVID happening in China, and there's concerns about Chinese lockdowns all of a sudden again, which, that's going to really touch on crude oil, which was down sharply on Tuesday, and also soybeans, which were down sharply on Tuesday as well. And then, you've got the continuation of, what's happening with Russia and Ukraine, some attacks on Moscow. There was an issue with the port of Odessa got hit with something over the weekend, which on Saturday, I was feeling like, oh, that might be something that's really quite bullish for the grains on Tuesday when we come back. But, after you read into it a bit more, it sounds like that was just some sort of debris that, like part of a drone that got shot down. And it wasn't an intended attack on the port of Odessa, or at least not the port facilities. So that didn't really support the market as much as maybe we thought in the middle of the weekend. So, yeah, just a lot of risk off coming together with that forecast. And wow, heavy.
How much of it was just profit taking as well, Ted? We had a 50-cent week last week up in July corn futures, and we got up into the 40-day moving average and couldn't take that out.
Yeah, absolutely. And not surprisingly, we ended the day on Friday sitting right on top of some very key pivot points for both corn and soybeans, with the idea that if we came back and that forecast was worse, we'd break through those key resistance points and have another leg higher. On the other hand, if that forecast wasn't worse, or maybe even a bit better, kind of like it was, then we would fail at these points and go down. So, that was kind of like clockwork with how the markets closed on Friday. And obviously we know the answer to that now. So yes, for the fact that we didn't start out of the gate quite a bit stronger, whoever had been long and, whatever funds had bought last week, probably were taking some profits here on Tuesday.
Yeah, no doubt. And then we get crop ratings out, the first one on corn this afternoon, and we're taping this before that comes out. But if that continues to look pretty decent, plus you see that extended forecast continue to be verified, that we're not really concerned about damaging the crop, is there going to be a lot more downside risk to the markets, the grains?
Yeah, there really can be, Michelle, because, a lot of people are going to say that we need to have a weather premium into these markets right now as we get into the first half of the growing season without knowing if we're going to make this crop or not. The problem that I have with that, and again, this isn't the argument that I'm making, but I could see this argument, which is with the prices that we're trading right now, above $5 December corn and, let's call it roughly $12 November beans. You do have some premium in these markets already. Maybe we don't need to build more of a weather premium. So if we don't have a bigger weather concern, if these forecasts, like you said, do start to trend more normal at the tail end of the forecast, and the closer we get to them, we get more confidence in that. Yes, unfortunately, I do think there is quite a bit more downside potential, because we've got a pretty sizable problem when it comes to demand. We just can't get our exports really rolling. We still need to get some more bean exports on the books. We're just not really seeing it. And the corn exports, the last 2 weeks have been negative in a time of year where we really should be seeing some pretty big positive numbers. So we've got issues on the demand side, which means that we can cut a little out of the supply side without having to worry too much about it. And again, unless we're seeing a major weather issue, unfortunately, I think we have to find some cheaper prices to rebuild that demand again.
Yeah, it seems like a big weather problem is the only thing that's going to turn the course here, and that's going to be a little bit unlikely. Okay, let's talk about this cattle market. New contract highs again in live and feeder cattle futures. And we've got the fundamentals really combining here with, the fund community still very long and going longer in this market. Do we keep going?
I think we can, Michelle. First of all, on Tuesday, feeders are the leaders, right? Feeders had a really great day, and a lot of that had to do with the pressure that we saw in corn.
Absolutely.
But honestly, I mean, box beef prices have really been very strong once again. Cash cattle, I think, has room to go higher. Packers margins are good, and we're getting into peak grilling season, peak demand season, and it's happening at a time where we just saw a cold storage report that shows a lot less beef in freezers than what we thought. So we have a tight supply situation. Demand is strong. We're not price rationing demand at higher prices. The American consumer so far isn't really balking at the higher prices that are being charged at the butcher's counter. So until that happens, or we have this major recessionary problem and it scares people from spending money at the grocery store, yeah, I still think there's more higher prices to come yet.
Do you think cash will be higher again this week in cattle like it was last week?
Yeah, I really think there's a good setup for it. Again, the Packers margins would justify it. And yeah, I do think we'll be, I'm going to say $1 to $2 higher.
All right. Limit up moves in some of the hogs today. I got to wonder, was that all short covering or was there more to it?
Yeah, and I really want to be careful what we say about hogs trying to find a bottom here. But, we had gotten to 25% on the relative strength index there at the end of the day on Friday. So we were in a very oversold position in hogs. And with the funds being the major short in that hog market, you figured it wouldn't take much of a spark to get us to go higher. And really, I mean, there's some positive fundamentals there for the hogs. Weights are coming in lower than expected right now, which means we're very current on marketing. We know seasonally we have a bit of a decline in supply here over the next few weeks. We're into the key grilling season, demand season. And we're trading at a big discount to cash. Futures are trading at a big discount to cash. So we just needed some sort of spark. And for the fact that we didn't start the day lower, I think caused that short covering happening in the funds. And we fixed that relative strength index. Now, whether we're able to build off a day like that and eventually say that the lows are in, I don't know. The way hogs have been trading, we could take it all the way again tomorrow. I don't know. But at least it gives that glimmer of hope and that optimism. I mean, when's the last time we saw a limit up day in hogs? I don't have the answer for that. But it's been a little while, Michelle.
Yeah, I know. You just wonder if it's a head fake, though. All right. Thanks so much for joining us, Ted Seifried, Zaner Ag Hedge. That's Markets Now.